Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
Welcome, everyone, to the Spend Life Well show, where we apply biblical wisdom to your financial journey. I'm Certified Kingdom Advisor Mark Trice in the studio with fellow financial professional Jesse Hamilton. Jesse.
Hey, everybody. How's it going, Mark?
Good, good. Hey, we're coming up in the election season. Everybody's putting their stuff out, and we're trying to make sense of everything. Seems like a lot of people are voting on emotions.
Yes.
I prefer logic, but
we were just talking earlier about the amount of people who make decisions based on hating somebody rather than, policy and logic and reason. But that's we're not here to influence you.
We're not here to influence you, but we are here today to talk about how elections move the markets.
Yes.
Because we get a lot of questions around this time every 4 years or so about so-and-so is running, what happens if they win, what happens if so-and-so wins. And there's a lot of misunderstanding and really just, I think, fear amongst
lots
folks
of fear
about elections and how that really can impact their portfolio. So we're going to break down some stuff. There's a lot of articles that are out there now. We shared some recently from the Wall Street Journal. Capital Group put out some pieces recently as well, and we're kind of talking about some of those points today. So, Jesse, why don't you kick us off?
So the first chart, it's really just 5 charts, but we want to comment on them and kind of explain what they look like
Which you won't be able to see in podcast form. That You're listening on the radio or on the podcast, and oftentimes we can't show you these things, but we're going to try to describe them.
So the S&P 500, right? That's the large cap index in the U.S., cap weighted, and it goes back many, many years. And if we go all the way back to 1933 and look at the series of political candidates for the presidency,
you were not even a concept or a dream in your great-grandparents' eyes.
My grandparents maybe were coming onto the scene in a couple years. But
I don't think so.
The first point, excuse me, here is that it's not really what we want to hear. It's that markets have trended higher regardless of which party wins the election.
Are you serious? Because this election is the most important election ever, which is what they say every 4 years.
Not necessarily true.
You're
but
saying
it's a big
that the
one.
markets tend to trend upward? Yes, the markets do tend to trend upward.
Yes.
Regardless of who's actually in the White House.
And of course, we're not talking about a day-to-day or month-to-month range. We're talking about years here, long-term investments.
Almost 100 years of history here.
But over, even if you shorten the period a little bit, basically over multi-year time horizon, the markets trend up after an election.
Right. Now, there were a couple of exceptions, right?
Yes.
But each of those times, there have been major economic issues that were going on in the United States or around the world.
Actually, off the top of my head, I think there were 4.
4?
There was the Great Depression.
Okay.
World War II.
World War II.
2000.
2000, the tech bubble burst.
And then, of course, the housing crisis.
2008 and 9, right. So there were underlying things that were going on within the economy which caused the market to decline in those times. It was not the result of who got elected to be president necessarily, not
That's
directly
right.
at least.
So sticking with the S&P, a lot of people want to talk about the makeup of Washington and gridlock situations.
Yeah.
In a unified government over that time period of 100 years, the average return on the S&P is 14.4% versus a split Congress is 13.7%, and a unified Congress with the president in the other party is 11.7. Is there an official term for that where Congress is unified and the president is not?
Well, I mean, they have all chambers of government.
Yeah.
Well, no, not all chambers because you got the judicial branch, but they've got the Congress tied up and a president that will endorse most of that party's policies and things. Now, gridlock actually can be a good thing. I know oftentimes people people will complain that Washington never does anything. Yeah, that's true. They don't do a whole lot of good, and many of us would wish they just stay out of our lives. But a lot of times gridlock can be good because it prevents one party from dominating the whole process, because you may or may not agree with that process.
Mm-hmm.
And so gridlock can be a good thing, especially when it comes to split houses. You know, the one party be in charge of the House and one different party be in charge of the Senate. So that can make things, and that's the way the founders intended. They wanted things to move slowly. They did not want to be wholesale drastic changes in that time. Now,
Mm-hmm.
another good point, Jesse, that this particular article talks about is that markets have tended to predict those election results over the past history.
And that's looking at the 3 months leading into the election. This stat really makes a lot of sense. In a positive return in the 3 months leading to the election, the incumbent usually wins. And in a loss leading into the election, the incumbent usually loses. And that's not necessarily something that we're predicting for this election. This is probably going to be one of those 4 of 24 that's different.
The oddball, yeah. And because past performance does not indicate future results.
Of course not.
So, and we're in a weird conundrum here, right? You know, the market's up for the year, but the economy doesn't seem like it's been that strong.
Mm-hmm. And people's sentiment is not matching those numbers.
That's right. So can we say, based on this, we can predict who's going to win the White House? Not really, no. Even though that's kind of tended to be that way when you have a strong economy and a strong market, it usually means that there's not as much of a push for change
Mm-hmm.
in the top leadership.
I'm sure there are places out there where you can place a bet on those 20 of 24 odds, but we do not recommend that.
Right. So, and this is a little bit different. This situation is a little bit different because you don't really you have an incumbent party,
Yeah,
and part of the administration that's considered incumbent, and then you have an incumbent from 4 years ago.
So the only true incumbent is not an active incumbent.
That's right. That's right. And this one here, I don't know. I mean, the Democrats chose their nominee. I mean, it was by fiat. It wasn't any type of democratically elected type thing. So who knows how voters will respond to that? But you know, in situations we see there are some historical patterns there that say, hey, if things are really going well, which makes sense. Hey, if everything's going well, why do we want to change, right? Yeah. And so there is some historical background to this.
So our next chart here, Mark, is an indicator of how conservative people are feeling by the flow of money in and out of equity funds versus money market funds.
And this is a very much an emotional decision, and we see this a lot.
Absolutely.
And I've gotten the question, and sure you have too, Jesse, do I need to pull my money out? And that's
they say, if so-and-so is elected, should I put my money to work or pull my money out?
And that's just playing with fire. You might as well go to Vegas and put all your money on one number if you're going to take that approach to fear someone getting elected and then putting all your money or out of the market or in the market based on that.
Right.
That's not an investment strategy. That is a gambling strategy. and really we're making those decisions. If you do that, you're making those decisions not based on informed information or facts. It's very much an emotional thing. Right. I'm not saying it's not real. I'm not saying that your feelings are not real, but it's not one that you want to do, because we've seen some situations where people pulled their money out of the market, and they regretted that in the years afterwards, because typically, money does flow into investments after the election. And the reason why, Jesse, is that there's certainty. And regardless of who is elected, Wall Street and investors will respond by trying to understand what's going on. Mm-hmm. Okay? And we now know that so-and-so candidate is going to be the next president. Their policies are this way towards Wall Street, and that will flow through. Investors will regain that confidence, if you will, in order to stay invested.
Yeah. So the stat is that over the last 30 years, the year after the election, there's there's more than twice as much money flowing into equity funds than money market funds.
Because
so people are putting
markets
their
know
money
what's
to
going to
work.
happen. That's what they're going to happen. So why do you need to pull your money out? Historically, this is what's happened. So there's really
Right.
not a need to go hide in the sand.
And
with
of course,
this.
that's from Morningstar. For those of you who want to fact check us, you can.
Yes, we have fact checkers on this podcast. Okay, that's good to know. Fact check us, folks.
You should run us through one of those political fact checkers and see if we're.
We should, yeah. Except the fact checkers, I don't trust myself because it tends to be a little bit opinionated.
Mhm.
And then the final one here that we're talking about is there historically has been, if you move to cash in election years, that can reduce long-term portfolio returns.
Right. So people who think they can time the performance of an index and their investments by pulling out and moving to cash during a tumultuous election time have proven over historical records to have less return on their investment.
And those are, can you give an example here, Jesse? Because since we're not showing the charts, we need to.
Yeah, so those, of course, this is based on Capital Group's own research and their board of governors from the Federal Reserve, actually. But those who remain fully invested over this time period, which in the article we're happy to send it to you, of course, they don't tell you what indexes it's in, but over the time period they investigated, the $10,000 investment turned into $15,860.
That was the S&P 500 index. So that's actually in the footnotes here.
Okay.
So yeah, that's the
Good to
S&P
know.
500 index.
So that's people who remained fully invested compared to the people who sat on the sidelines and tried to re-enter. They were down in the over $1,000 less.
Yeah.
Over that time period.
And so staying uninvested can hurt overall long-term returns. That's what we're trying to say with this. And timing those markets, that's really hard to do.
And we don't claim to do that. Nobody claims that they can. If they do successfully claim that they can time the market, then that's a problem.
It is. And you have to be leery of those situations. But the bottom line is, if you choose to pull your money out before an election, there's probably not a lot of facts that decision's based on. Make sure you're basing that on data that you have analyzed yourself, and you're making a determination that this is what we need to do. Now, if you decide to do that, that's your business. We're not going to try to stop you from doing that. What we're sharing with you today is historically, on average, this is what happens in an election year and the year after election year. It's important to remain patient. Let the election take place, and please don't watch the commentators on television because many of them will. I remember the last election, 2016, and there literally was a reporter that started crying because she's claimed that her 401k was going to be destroyed, and I'm guessing it's probably doubled since then.
Probably.
Yeah.
Well, of course you're thinking of some investment advisors and an investment company tell you to stay in the market. Yeah, that's surprising, but we are viewing this from a biblical worldview, from a faith view. And we don't serve a God who tells us to hide in a hole and get scared and try to time things. In fact, the Bible tells us that we should invest and grow our money and not have that spirit of fear.
That's right. We don't need to live in fear. We need to move ahead and forward. You know, if you want a professional opinion, you can contact us. That's always a possibility. How do they reach us, Jesse?
You can text us at 254-282-0495 anytime. That goes to our phones, and we can answer your questions or schedule a call if you want.
Unless it's 3 a.m. I don't do text.
You probably won't get
a
a response until business hours. But
or you can visit us on the web at clearvistafinancial.com or thespendlifewell.com. Those both go to the same address. But until then, folks, don't panic. No need to run for the exits. Remain patient, remain calm, stick to your plan, and invest for the long haul. Until next time, you've been listening to the Spend Life Well Show.